Today we should do some things. Write that down. Oops. First thing I do is share my screen. Okay, so tonight I want to talk about Microsoft Office 365, just because all students have it. And I say that I've had a couple times in the last week or so, students say, well, I don't have, I don't have a Microsoft Word or whatever. You actually do, and I'll go into it in a minute. But anyway, and then we're also going to start working on the Chapter 10, 11 handout. I'm not sure if we'll finish it, but we'll see. And the monetary unit sampling, we'll dive into that one again. So anyway, Microsoft Office. Let me. Oh, that is not the right one. Okay, Microsoft Office. Everyone at Roosevelt can use it. There's a browser-based one. You can also download the files itself, but every student has access to Microsoft Office. And the way you get into it is not that. Not that. Go to your email account. Wait a really long time for it to load. And if you go over to this, I don't know what you call this thing, little grid, little clicky grid. Hope I'm not being too technical with you guys. Go over to the little clicky grid. And if you click on that, you'll see these are all the applications that you guys have. And so you go into your regular email account through the school, and you go through any of these. If you want to use Word, that's a lot of times what I'm looking to use. You click on Word, and it'll come up something like this. Click, click, something like this. And this is a little bit hidden, but there's this upload thing. So when I send you the files, download them either onto your device or onto your computer, whether it's Apple or a PC or whatever it is. Download the file. And then you can click on it to upload it into Word. And that way you can edit it. So go back to here. So again, it's a little bit hidden down here, but this upload thing here, we can upload the file. So I'm going to upload a file. Upload a file from our class. Let's it's over. I'll upload this Tonight file. How about that? Okay, so this is the Tonight file. It's uploaded. Now I could, make changes to it and all this kind of stuff, whatever you want to do to it. Okay, now if I want to, I can save it as, what is it doing here? File. If I want to, it's a little bit kooky, but if you go to this more options, it's got all the main stuff here. New, open, and then here's more options. And I can do save as, and I can save it as a PDF file. So you can save it as a PDF file, or you can save it as just a plain Word file and submit it that way too. So anyway, you have access to Word, and if your teacher wants it in a PDF file, you can save it as a PDF file too. So you can work the documents and then save them as either Word document. Teacher will take those, or as a PDF. And for me, it doesn't make any difference. You can do it either way. But anyway, so everybody has everyone has Excel, everyone has PowerPoint, Word, and all that. You don't need to buy it again. You've already paid for it in your tuition. Somewhere, I already figured it out. I don't know, but somewhere in there, it's yours. Any questions on that? No, I know some of you already known that. The only reason I bring it up is because some people have indicated that they didn't have it, but actually everybody has it. So however, it wasn't communicated. It wasn't communicated effectively. Everyone has that. Okay. Questions on that thing? All right. So again, everybody has this, and you can also download it. I'll give the link for it. There actually is a link to download it if you want to install it on your computer. You don't have to. I'm not sure how much space it takes up, but you can actually install it on your computer. And what I've been told that makes it more stable. It's more stable if you actually download it. But either way, you do have access to it. Question on that thing? Okay. So and again, sometimes people will say, "Well, I don't have Word, so I can't fill in the document." You can do it. It's just you have to save the file to your device, edit it, and then send it back in. Now, you're probably wondering, why doesn't this guy use the OneDrive? I don't use the OneDrive because in the past we've had real problems with it. OneDrive, the problem with it is that well, first of all, it's secure, and you can access your stuff from anywhere. The problem with it is, for running a class, is that a lot of times you're dealing with permissions, and these permissions will block things from happening. These permissions will block you from opening it, they'll block you from saving it, and all that kind of stuff, because they don't know if it's a bad thing or a good thing or whatever. Sometimes it's the permissions built into the OneDrive. Sometimes it's actually built into the whatever the programs are, the applications. So because of that, I don't. After several irritating weeks in the past, I've figured out that while theoretically it is better, safer, all that kind of stuff, the actual using of it makes it more difficult. So that's why I send out the actual files. It'd be really easy for me just leave them all on Blackboard though and assign them that way, or in the OneDrive, but it doesn't. The actual using of them isn't as useful that way. Question on that? And by the way, I had the same thing happen with saving the recorded meetings to the cloud. They think about how much safer they are and all that kind of stuff. In the actual fact, I lost 2 lectures of saving it to the cloud, and since now I save it on my own computer, and I've never lost one. So that's the reason why I do it that way. Okay. Well, let's go to. All right, I think we stopped on page 3, or maybe it's page 2. Except on number 4, I think, or G of the Chapter 10 handout. Okay. Is there one that does not have the Chapter 10 handout? Okay. All right. Well, we'll stop in. We're going to do a couple little definition-y things, and then we're going to do a bank reconciliation. Okay. Some of these are terms you guys already know. Electronic funds transferred, often is abbreviated EFT. And these are transfers that are made between banks. It's a secure transfer, And it is done from account to account, a secure account to a secure account. And these electronic fund transfers are good because they eliminate the paper. They're much quicker. It's almost impossible to do things like kiting from this kind of thing. But it's a very fast way of doing it, and it's a very it takes out a lot of the problems you can have with fraud in it. So funds are electronically. Funds are electronically transferred. A lot of mortgages will only take electronically transferred funds. They don't take, you can't write them a check. They'll only take the electronic ones. But, okay, so electronic funds transfer is just a system that lets start writing checks. A lot of large companies, you'll have to use their electronic funds transfer to do business with them. Ford started it way long ago in the 1980s that if you didn't take electronic funds transfers, that they wouldn't do business with you. So it's been around for a long time, actually. Okay, bank forms. We have really three flavors of these. We have the and these are the ones that are more in the taking the CPA exam and that sort of thing. These are the more beat up ones. The ones that are used quite a bit. Standard bank confirmation form, year-end bank statements, and cutoff bank statements. Okay, standard bank confirmation form. These will confirm probably right. So standard bank confirmation form, these will confirm accounts, loans, and collateral as of year end. They will have the loan interest payments. So any balances. Oops. Loan terms. Interest. Outstanding amounts of the loan, outstanding. Say loan amounts outstanding. Now, I actually have one of these to show you guys, but it's not a very good one. I meant to get a better one this quarter, but I didn't have it. So this is kind of what a bank confirmation. Again, this is not a very good one, but this is kind of what it looks like. If there was a loan amount, it would have been in here. These are the accounts that it has for the bank: the general account, payroll account. We'll talk about the ending balance in those. This one doesn't have any loan terms or anything like that. I'm trying to find one that does that I can download. But anyway, there is something you notice about this though, and that is it only shows the ending amounts. It doesn't show the checks that were written. It doesn't show the deposits. It doesn't show anything. It just shows the ending balances. Now you can use that. I mean, these should match up with the year-end bank statements, but as far as the accounts themselves, as far as the activity, it doesn't show any activity. It says as of 12/31 or whatever the year end is, this is what it is. And again, if there's a loan here that had been a loan amount, what the terms were, what the collateral was, any loan covenants, and for instance, they may have to have a current ratio of 2 to 1 or whatever it is for the loan. So these are all the requirements that are of the loan would be in there. So this would confirm what the client will have for their loan amounts on their books. This should be it should confirm that amount. Another thing about banks is a lot of times they will make a requirement that a company does all their business through that bank. They'll say, yeah, we'll give you this loan, but you cannot do banking with another bank. They don't want you running around getting a bunch of loans from a bunch of different banks for the same thing, and then running away to Acapulco and never showing up, and never coming back. So they'll usually say, look, you have to do all your financing through us. We'll give you the loan, but it's got to all come through us. Point being, though, is that if they do that, then you need to confirm that the client is living up to that, that they aren't getting from somebody else. And we'll talk more about it later, but it could be, even a small amount could be material, because it might, a lot of times the loan will be due immediately if they violate certain terms of the agreement. So anyway, again, this isn't a very good example. I meant to find a better one, but. Okay, so bank confirmation form. The big thing here a lot of times is this one. This is what you really want to look at for the bank confirmation. Yeah, the account balances, it'll let you know if there's any accounts that the company doesn't have on their books or anything, but it will all, but the big thing is this, the terms of it. And you should be able to figure out whether they're the amount of their loans and the amount of interest expense that they're going to have on those loans. Okay. Year-end bank statements. You will have, one of these will be sent to the client. And used for the bank reconciliation. One will be sent directly to the auditors. So reconciliation, I got too many L's, I think. And not enough R's in this one. Okay, so the auditors will be sent a bank statement directly to them. So here's a question: why don't the why do the auditors have a bank statement sent directly to them? Why don't they take the bank statement that was sent to the client? The client already has the bank statement. Why don't we just use theirs? Oh, come on. You guys know this. You're toying with me. Anyone?
I'm sorry, I don't understand your question. Say that again.
The bank statement, so a bank statement, obviously the client gets a bank statement, but we then as auditors, we require the bank send us a bank statement directly.
Just to make sure that, I don't know, that we're recording everything correctly and that it's not being, I don't know.
Not being, yeah, no, I think you're on the right track.
Yeah, but I can't get the words out of my mouth.
They could alter it.
Correct.
Yeah,
There you go.
so you don't want to use their bank statement, and we have this hierarchy of data and that of evidence that we want it directly from the third party. If you get it from the client, they may have altered it. So we get it sent directly to the auditors, and we use that to check their bank reconciliation, check their some other stuff, payments and all that kind of thing. So we get a bank statement sent directly to the auditors from the bank, and the client has to agree to that. What do you think we do if the client doesn't agree to it? So client says, I'm not going to have the bank send you our, let's say we're auditing IBM. IBM said, we're not going to let the bank send you directly our bank statements. What do you do? First you roll your eyeballs, and then what do you do? What is it when someone refuses to give you information? Does that make you more suspicious or less suspicious?
You're hiding something if you don't want to provide that information.
Exactly.
Almost, yeah.
Whenever a client doesn't allow you to get information you need, immediately that raises suspicion. And either they give you the information, or you can't do the audit. You can't finish the audit. Like, for instance, let's say that they're having a murder investigation. They come into my house and I say, okay, yeah, you can look anywhere in the house, but not in this closet. Well, that's the first place they want to look, is in the closet. So it's the same thing. Whenever a client refuses to give you information, it makes you really want that information even more, because there shouldn't be a reason why they want you to have that information. So we have the bank statement sent directly to the auditors. If the client refuses, you either give them a disclaimer audit, which means no opinion, or you withdraw from the audit and say, look, we can't finish the audit. Okay. So that's a year-end bank statement. Did I even talk about these? I can't even remember if I tell you about these or not. Cutoff bank statement. Now, cutoff bank statement is a bank statement made. See what it is. Say 7 to means 7 to 15 days after year end. For example, January 10th, 2022, have them send another bank statement, but it will only be up until, say, January 10th. Okay, so year-end bank statement is a cutoff bank statement is only up to a certain date. The reason we do that is that there are things on the bank reconciliation, which we're going to get to in a minute, that will become more clear when we get those bank statements. So for instance, if they said they made a deposit at year end, well, by January 10th, that deposit should certainly be in their bank account. And this too is sent directly to the auditors. The client probably doesn't get one, probably doesn't want one. I'm sure they could have one, but it's more for the auditors that we get it sent directly. So the auditors are going to get 3 things from, oh, I just put that up here too. For cash. The bank confirmation form will be sent directly to the auditors. The year-end bank statement sent directly to the auditors, and the cutoff bank statement sent directly to the auditors. Usually the client doesn't get this because they don't really care about it. They're not going to, they're not going to use it for anything. But these are the 3 banking forms that we will get from the bank that are very important to an audit. The bank year-end bank statement, bank and cutoff bank statement, these relate directly to transactions that we're going to look at. The standard bank confirmation does not look at transactions. There's no transactions listed on it. It just shows the ending balances and the terms. It doesn't show checks written, deposits made, none of that is in there. So this one's sort of like a snapshot picture of their banking agreements at year end, as of the year end, not any time in between. Whereas these, the bank statement shows what they did for the last month. And this one will be for the last, whatever, 15 days. Okay. So bank reconciliation. Reconciles bank balances with the clients. Balances. When I say balances, they may have more than one account. So reconciles bank balances with the books, with the client's book balances. And one of the things that they try to find the objective. The bank reconciliation. Scratch that. Find the correct cash balance. So we got to find the correct cash balance based on our bank reconciliation. So that's really is the goal, to make sure that the cash shown on the bank on the books are the same thing that they actually have available to them. Okay. Which of the following can be verified by a standard bank confirmation? I'll give you a hint. It's all but one of those. I should maybe rewritten this to say what cannot be verified.
The ending bank balance as of well, depending on the fiscal year.
Actually, all of these can be the one that can't be verified are the daily banking activities. Now, this is on the standard bank confirmation. This is that first one that just shows the ending balances. It doesn't show any checks coming in or out. So all the rest of these, it can find. The loan agreements. Those will be on. This is the, the bank. Well, I showed you guys didn't have the loan agreements, but the loan agreements will say the term of the loan, the interest payments on the loan, the collateral you must have, all that would be in there. It will have the ending balances. It won't have any activities, but it will say at year end, this is what was in the account. And it will also say the collateral pledged for financing activity. So it'll also say, okay, here's a loan for inventory, but it's backed by the inventory, and so you may have those kind of situations. It could be backed by something else. It could be backed by a building. It could be backed by anything. But the collateral pledge for financing activities will be also on there. So the bank confirmation, it doesn't show you activity at all. It just says at the end of the year, but it's very important. And these loan agreements, these are important for the audit because if the client is in violation, the client's in violation of these loan agreements, it could mean that the entire loan amount is due. It could mean the client may be bankrupt, if they're in violation of it. Why is that important? Because when you're doing the audit, when you do the audit and you know that the bank is going to be looking at these financial statements to see if the client is in compliance with the loan terms, then anything that violates those terms is important. So you're going to be looking at those different agreements. So if they are supposed to have, 60% of the loan value in inventory, you got to check that, if whatever the loan value is, that they have at least 60% of that in inventory. And here's another thing too about loan agreements and this sort of thing. We talked about materiality before. Even something that's immaterial, if it violates the loan, if it violates a loan agreement, might be material because it violates that loan agreement. Because whoever's reading it will want to know if there's anything wrong. So for instance, a lot of times the loan agreement will say that they have to do all their financing through this bank. You go through the audit and you find out that they're getting a small loan from some other bank. Well, that violates the agreement. Even if that other loan is immaterial, it violates the agreement. You're going to have to disclose it because it becomes material because it's in violation of a contract. So, there's a lot going on with this, but especially these loan agreement things are very big. You have to audit those because they can change how you do the audit. Okay, which can be verified through cutoff bank statement. And the answer is all of these. All of the above. Deposits in transit. If they made a deposit at 12/31, it should probably be in the bank by the 1st or 2nd of the January. Unrecorded liabilities. If you find things that are paid in the first couple weeks of January, those probably should have been liabilities at the year end, right? That's just the way things work. A lot of times something will happen, then you get a bill and you pay it. Well, if you're paying for something at the early part of January, it probably means that there was something delivered before year end. Not absolutely, you're gonna have to look at each one and see what it is. And kiting, which we haven't talked about, you can also find that through the cutoff bank statement. The cutoff bank statement is very, very important. This is, probably among these, this is the one that they, well, a lot of times will beat up on the CPA exam. This cutoff bank statement. Because you can find so much bad stuff that happens with it. Okay. Now we're gonna put on our thinking hats and go back to way back when we did. Does that fit on here? I think it'll fit on my page. I'll economize, I'll move this stuff up a little bit. Okay, we're gonna do bank reconciliation. So this above is our bank reconciliation. This is our data up here. And what we're going to do is do a bank reconciliation down below. In the CPA exam, there are two different parts that you might end up with a bank reconciliation. They may have it in auditing. They may have it in the regular financial reporting section, the FAR section. So the auditing section and the FAR section, financial accounting and reporting section. So it's a very big thing. Cash is very important, and this is kind of how they verify the cash, a big part of it anyways. Okay. So generally what we do is start out with, change this. We have our I'm gonna put caps on, not because I'm angry, but because it just, you can see it better. We start out with the bank balance. Hold all of these. And over here, we'll have the book balance. Okay, so the bank balance will be $2,400. And the book balance is $1,950. So obviously these are not the same number. They usually won't be. But we're going to go through and reconcile both sides, and we're going to come up with a correct balance. And the correct balance would be for both sides of this. Okay, we're going to add some things. To the bank side. Add some things to the book side, and we're also going to take some things away. From each side. Not necessarily all the time, have all four of those, but it's a possibility. Okay, and I know you guys maybe have not done the bank reconciliation for many moons, but we'll kind of go through this again. Okay. Basically, the bank reconciliation is one side is going to be right, and the other side is going to need to adjust their books or need to correct their side. So there's some things that we know that the bank doesn't know. There's some things the bank knows that we don't know. And usually the stuff that the bank knows, we get off the bank statement. You know, and the bank statement will have those things that we don't know. For us, though, the things that we know that the bank doesn't know, and that's usually things that have a delay, which we'll talk about in a minute. Okay, we'll talk about right now. This second, we'll talk about it. Okay, deposits in transit. If you make a deposit on 12/31 at 4:58 in the afternoon, is that going to be in your bank account that day?
No.
Nope. That's what a deposit in transit is. Something made near the end of the period, usually the last day of the period. But you made a deposit, and you know that you put it in the bank, but the bank doesn't know it. The bank says, no, we got to wait for that to clear and all this kind of stuff. So we know that what we did, the bank just doesn't know. So which side are we going to correct? Our side or the bank side?
The bank.
Yep. Yeah, we know we made a deposit. The bank just doesn't know. So we're going to go to the bank side and say, we made this deposit in transit. Deposit in transits will always be added. No, I should have asked. It'll be added subtract. So deposits in transit. Now, in this 1950, we have that 550 deposit. The bank just doesn't have it. Oops, oops. I think I said 5,050. It should be 515. Oh, I'm in the wrong spot. Okay, deposit in transit. So deposit in transit, that is something that we know we made, but the bank doesn't know. They haven't counted it yet. Okay, electronic fund payments. This one thing that are transferred electronically. Now, it really kind of depends on your system, but in general, do you write a check for electronic fund transfers? No, they're done electronically. You don't need to write a check. The whole point of them is that you don't write checks. You don't have to wait for a check to clear or anything like that. So a lot of times these electronic fund transfers, especially the stuff you receive anyways, you won't know about. And you'll probably find out about it on the bank statement. So which side are we going to correct for these EFT payments and receipts? The bank side or the book side?
The book side?
Yep. Yeah. The bank knows that these payments were made. We just don't know. So let's see, we're going to add the EFT receipts, electronic funds transfer. And these EFT payments, again, there's no check involved. $120. Smaller, yeah. Okay. All right. Now the NSF check, that's not our check. That's a check that a client, or a customer gave to the company. So a customer gives a check to the company and $240, maybe, they may even check to see if there was money in the account, but for whatever reason, it came back NSF, non-sufficient funds check, $240. So we put it in with our deposits and now it got kicked out.
You have to reverse it on your books.
Good. Yeah, the NSF check, usually the bank, it depends on the size of your operation, but a lot of times if it's a somewhat a common thing, they'll just put it in the bank with a bank statement of the returned checks. So NSF check, you have to take it out of your cash. Because in that 1950, that $240 is in there, but we got to take it out because it didn't clear. And you don't forget about it. You help the customer and have them come buy the check back from you for cash or something. In the state, I don't know, maybe even changed it now, but in the state they used to have the NSF check that you could collect 3 times the amount if you turn it over to the state. And the point being is that they want you to, go to whoever wrote the check and say, okay, if we give it to the state, they're going to come to you for $720. So, okay, outstanding checks. Now, when you write a check, right? So in your system, you print out the checks. Does the bank know about those immediately? When you send out checks?
You have to add them on your bank side.
Right. We know we wrote the checks. Now we put them in the mail. It takes a little while for the mail to, let's say we wrote the checks near the end of the month. It takes a little while for the checks to get to whoever you're sending them to, the vendors. It takes a little while for them to deposit them. It takes a little while for them to clear the bank. So there could be quite a bit of delay, several days, in far as these checks that you've written. So you wrote the checks. The bank doesn't know. The bank's sitting there waiting for these to hit, but they have no idea that what's been written. So we're going to correct the book side for these outstanding checks. minus. So we wrote $800 of checks that the bank doesn't know about. Bank fees. Do you write a check for bank fees?
No.
Nope. You do not write a check. They just take it out of your account. There's no writing a check. So you're not going to have a check in your system for that. So which side do we have to?
Your side, the books.
Right. You're probably not going to know about the bank fees, what the total is anyways, until you get the bank statement. And note collection is kind of an odd one. I don't know if it happens that often, but in bank reconciliations on the CPA exam, they assume it happens all the time. So we are going to too. A note is similar to a post-dated check. So a note is it's a legal document. A note is like you have a check that you write the amount and you sign it. Same thing. That's what a note is. But it says, okay, this is going to be kind of like a post-dated check. I'm going to pay you this money, but not for 90 days or whatever it is. And you sign it. But just like a check, it's a legal document. You are required to pay it no matter what. Whoever has that note with your name on it, just like a check, you are required to pay it. Notes often will also have interest involved. So they say, okay, I'm going to pay you in 90 days at the annual interest rate of 5%, whatever it is. So, it's a post-dated check, basically, saying I'm going to pay in the future. And sometimes it'll have an interest element to it, of extra interest added on because of this late payment or delayed payment. Now, here's the thing. A note is very similar to a check. They're both legal documents. They're both signed. Whoever has it, you're required to pay them that amount. So there are a lot of similarities between notes and checks. So it isn't unusual for a bank to collect something like a check because that's right up their alley. Whereas if I'm running, say, a bicycle shop and someone, I sell someone a bicycle for whatever, $2,000, and they give me a note, I'm not in the business of collecting notes. The bank is, for a fee. I'm sure they'll collect it because it's similar to a check. So it makes sense that you would actually have a bank collect it for you, just because it's probably not part of your regular business. I'm sorry that is not. Okay. Didn't realize that was teetering on something. Okay. So let's get back to this. All right. So there's no collection. You're probably going to find out about it in the bank statement. Now, this is note that they collected for us. So we add it or subtract it from our side?
You added to
Yep.
your books.
So we're going to have $500 added to it. Interest income.
Added to your books.
Yep. Probably find out about it on the bank statement. They'll do the calculations and they'll say, here's your interest income. Okay, now, if we've done it correctly, we should come up with a corrected balance. Oops, oops, oops. For each of these, for both sides.
It's
You should-
2,115.
To 2,115, you said? For both of them?
Correct.
Okay, thank you.
Yep.
So this is the whole idea behind the bank reconciliation. You start out with two different numbers up here. Usually they're not the same, but coming down here, this is where you have the corrected balance. Now, there is a very important part of this when we talk about this for auditing. And that is that these things to the book side, these have to be journal entries. They're not just going to magically appear in the account. So these are going to be journal entries. So for each one of these, you're going to have a journal entry. You know, so whatever these EFT receipts were for, was it for? I think it was for revenue. So you're going to have a journal entry like this. $50. For each one of these, you're going to have a journal entry to correct the balance. So that this is the balance that should be on your books after you do the bank reconciliation, 2,115. So for each one of these, you're going to do it. So up here, where's the note for? So this would be 500. Oops. See note payable. So you make journal entries for all of these on this side to correct your books. And that's one of the things about the bank reconciliation. It isn't just a check to make sure that everything is on the up and up with the bank. It's also there so that the client will correct their books. So if you have a client that's not doing a bank reconciliation, it's very likely their cash is misstated, up or down. It could be either way. So these are all journal entries that must be made from that bank reconciliation. Question on that? So again, it's very important that the client does the bank reconciliation so that they can do the journal entries correctly.
Can you please scroll down a little bit? Okay.
And again, so there's 6 things there. You have 6 things in the the journal entries. And it could be anything. It could be whatever it is. It could be an error. It could be all kinds of stuff. So all of these are going to be the tricky one would be the NSF check, because that would be accounts receivable. You're not going to forget about it, and cash. But all of these would be put on as journal entries. So if you have 6 things on that side, you'll have 6 journal entries, and then your cash account should come out to this corrected balance of that.
So I have a question. So with the deductions, the cash, it's always going to be the cash, and then so cash and EFT payments is going to be reverse of the arrangement, right? It's going to be the EFT payment is going to be, is it?
Well, we got to look at whatever it's for. For instance, this one, the EFT payments for rent.
Rent. Oh, okay.
Yeah. So this would look like, well, here, I'll do that. So it would be like rent expense for, what was it, 120? I think it was 120. Can't rent too many things now for that, but okay. So and then cash. And there's always going to be a cash part in each one of these, because that's what we're going to try to correct. So
okay.
whatever the payments are for, you're going to put it as a journal entry. Yeah. And,
Okay.
and for everything on the side, and so the real goal is at the end of the period, this should be what you have in your cash, not 1950.
Okay.
I had to deal with a real wacky controller at a assembly plant. Actually, Melrose Park was for when we're at Navistar. And the guy didn't do bank reconciliations for a couple of the accounts. And here was his reasoning. The bank amount was always higher. Okay, it probably will be because there's outstanding checks. That doesn't, the cash is wrong. But anyway. All right, so I think we're gonna stop there. I gotta make a decision of what we're gonna do next. Because the bank reconciliation, like on the CPA exam, these are tough. I think I'm gonna do these. I think we'll. No, I won't. I tell you what, we come back, we'll go, we'll mix it up. We'll go with the thing we started last week on the monetary unit sampling. Oops, where am I at? So last week we ended up on page something. I think we ended up there. So I think, yeah, so let's do this. Let's do, let's say be back at 6:10? No, wait. Can't jump in the time machine and go back to that. 7:10?
Okay.
And we will start up with the monetary unit sampling. It's going to kind of break this stuff up a little bit. So anyway, so yeah, so be back at 7:10 and we'll start up with this. Question on that? Okay. I'll turn on the doggy cam. I'll focus the doggy cam. Got clear to there because I'll probably be using it. Okay, so I think we're number 5. And number 5 is it's probably the most, the biggest amount of a problem they'll give you on the CPA exam. They have given this pretty much this exact problem, this exact layout, several times on the CPA exam. When I was going through, we used the same basic type of a problem. I don't know if I told you this or not, but they used to, the CPA exam used to be an open exam. And that when you went in to take the exam, they'd hand you the exam with all the questions on it. And then they'd hand you an answer sheet packet. And you'd write down your answers on the answer sheet packet. That one you'd hand in. The other one, you'd put in an envelope, give it to them, put in an envelope with it, and they would mail it to you. You'd actually get back the exam that you took. It was what they called an open exam. You could see the questions that you took. You know, depending on what notes you had on it, you get exactly the same one back. It was all written, you know, by hand at that time. But anyway, so there are a lot of CPA questions that are actual CPA questions that are out there. They stopped doing that in 1996, which I know was probably before you guys were born. But a lot of this stuff hasn't changed. You know, a lot of these auditing techniques haven't changed for 100 years. So probably proportional size, or now called monetary unit sampling, that's been around for a long time. And so there are actually real CPA exam questions based on those, you know, those topics. And this is one of those. So this is a format that, excuse me, you would be very likely to see back in my day and you know, going into the future. Okay, so monetary unit sampling, and it basically is this. It's when you're going to find out a projected misstatement, which we've done before, but then it's going to say, okay, because this is sampling, it still might be off by a little bit more. And the question is, how much more could it be off by? And so that's sort of what we're going to do here. Okay, so let's go ahead and do similar to what we did before. So we have our audit value and our book values. And we basically do a ratio. It's basically a ratio estimation. So we say, okay, the audit amount was this. Divided by 10,000 times 50,000. So this would be our projected value. Oops. All right, so we gotta get out the calculator, and I will go to the calculator camera. All right, so 8,000 divided by 10,000, those 80% times 50,000. So here's what we're saying. We're saying that this interval really isn't worth 50,000. It's worth it's worth 40,000. Okay, so what's the projected misstatement for this interval?
10,000?
How much?
10?
Yep. Yeah, so we're saying that it is projected misstatement is 10,000, and this is really the important number. they only found 3 things that were wrong here. So, I don't know what the sample size is, but they had 6 million and the interval is 50,000. So you can figure out how many items in the sample there were. 120 maybe. Anyway, 23 months. So we're really looking for the misstatement here. And we won't worry about this incremental allowance just yet. Okay. Coming down here. We have 1,600 divided by 4,000. Times 80,000 equals some number. Okay. %. So this is worth what, 20,000? Okay, so the misstatement would be 30,000. Because we're saying of this $50,000 interval, that if it's really only worth 20,000, then it must be misstated by the rest of it, right? So if 40,000 of it is okay, then the other 10,000 of this interval isn't. This one down here is a little bit tricky, and it goes back to what we did when we left. And it comes down to this one. Hey, it didn't change. Okay. Monitoring unit sampling is only used to detect overstatements. Understatements are ignored. So if the audit value is bigger than the book value, back to our audit value, in this case is bigger than the book value, it's ignored. So for this one, because this is bigger than that, this is an understatement. I don't like, I'm sorry, I stop using capitals. It looks angry or something. And understatements are ignored. This method isn't supposed to find those. When it does find them, it ignores them. And so that's another thing that's kind of quirky about this method. Usually when you're doing sampling, if you find an error, it has some importance to it. Say, okay, this is an error, high, low, whatever. For the probability proportional size, if it is an understatement, we ignore it. It's only supposed to find overstatements. If it finds an understatement, we throw it back. We don't do anything with it. So that's another quirk about this method, is that it ignores understatements. So we don't do anything with it. Okay, so these together will be our projected misstatement. So 10 plus 30. $40,000. And this is our best estimate. Our best estimate of this statement is $40,000. Any questions on that? Okay, so I'm going to kind of show you a piece of paper here. What we're going to do next. Okay, so this is what's kind of going on here. So here's their book value. Which is the same as the population size. And I think I talked about that last time. If I didn't, I should have. Now, population size, each dollar is actually a unit. So whatever the book value is, that's how many units. So in this case, there's $6 million in the book value. That means there's 6 million units of dollars to pick from. That's why it's monetary unit or dollar unit sampling. That each dollar is the same as an individual item. So one of the weird things, population size and book value are exactly the same thing in this one. Okay, and so here's what we're saying. Okay, they're saying that the that it's on the books for 6 million. All right. We're saying that it's off by, it's misstated by 40,000. So whatever that would be. So this is our, we're saying it needs to be 40,000 less. So whatever that is, what's 6 million? So this would be our projected value. Whatever that is. Is it 5,960,000? If I did the math right, that's it. So we're saying, okay, look, this is what it really should be, right? This is our best estimate. However, also remember though, that this is a sample. We didn't take 100% of everything. This is a sample. So it could be off by even more, right? And, depending on what your, how reliable you want this thing to be, it could be off by more than that, just because it is a sample. Now, here's the thing about this, and I'm sure you guys had ran into this in your statistics class, and that is that there are one-tailed tests and two-tailed tests. This one would be a one-tailed test. It's only good for overstatements. So it's going to look like this. We're saying it's off by 40,000, but it could be off by more. But now here's the thing: is it's only going to go this way. So, you know, like a bell curve would normally go both ways. For this one, it's only good for it ignores any understatement. So this is only for overstatement. So it'll go this way. And there's two things that go into this. One is the basic precision. I should say number two because I just never look at my sheet here and see what it is. I'm going to do this differently. So this would be B. Basic precision, and then C, incremental allowance. So these two things are going to say, okay, we know our best estimate is off by 40,000, but this is a sample, so it could be off by more. The question is, how much more? How much more could this be off of at the 5% level or 95% accuracy level? So how much more could this be misstated because this is a sample? So but here we go. So we're saying it could be up by more for this basic precision. And this incremental allowance, same thing, it could be off by more because of that. You know, whatever that comes out to down there, I don't know, but that's what we're going to figure out. Okay. So let's go back to something. Here we go. Oops, what am I doing here? All right, basic precision. Now for this one, oh, I just closed it. I do know what I was doing there. For this one, I'm going to open up the monetary unit sampling tables thing we did last time. The table, I think last time we did something. 1 second. We did problem 3 on. I did problem 3 on here anyways. I don't know if you guys did or not. So I'm going to go to a clean table. I'm going to say MUS formulas 2. And basic precision, this is going to be B. So this is problem number 5. Basic precision. Basic precision, you calculate that by the sampling interval. So what is our sampling interval?
$50,000.
Yep. So our sampling interval is 50,000. Oops. Times the reliability factor at 0 misstatements. Okay, so we got to go back to our tables. Okay, so reliability factor at 0.
3.
Yep. So I'm gonna plug that in. Ah. So our basic precision equals what? 150,000?
Yeah, that's right.
Okay, so this is what our basic precision is. So coming back to our problem here. Basic precision, I'm gonna go ahead and type it out again. So it'll be $50,000 interval. Okay, so here's what we're saying so far, anyways, that this thing could be another 150,000. So basic precision means that this could be up by another 150,000. Now you may be wondering, okay, well, what is that? What is the basic precision? What does that even mean? You know, that it could be off by 150,000. Well, basic precision is, it's love. That's what basic, no, it's not. Basic precision is the, if no errors were found, the counts may still be misstated because this is a sample. I should say not errors, misstatements. That the books might still be misstated. So if no misstatements were found, the books could still be off by 150,000. So even if there were no, you know, there wasn't any misstatement here, the books could still be off by 150,000 even if we didn't find anything wrong. So if no misstatements were found, the books could still be off by 150,000. Any question on that? And you know, yeah, and the thing to keep in mind is this is sampling. So like I say, even if you find everything's fine, it's just a sample. There's still a possibility things could be worse because you know, and the only way to get around that is to test 100%, which is not usually feasible. You know, it could be impossible, but a lot of times it's not feasible or necessary to do it. So as long as you have a sample, there's a possibility it could be off some, and that's what you have to, you know, work at. And at different acceptable amounts. You know, if you have a 5% chance, it'll be different than if you have a a 10% chance. And you can actually see that. Let me show my screen again. You know, if you look at this, no, not that. If you look at this, you know, notice you multiply this by the interval. Notice that if you want to be 10% sure, it's a lower amount, right? A little more slack is given because instead of being 95% sure, you can be 90% sure. You know, it's at 2.31 times 50,000, some number, but it's going to be less than, you know, 3. And on the opposite end, if you want to be 99% sure, it's going to be a bigger amount, right? So it depends on how accurate you want to be, is where that, you know, kind of ends up. And usually, like I say, usually we use my hands to show a bell curve, but for us, it's really only one side of the curve because we ignore understatements. Okay. Okay, now for the incredibly wacky one. Incremental allowance. Incremental allowance is this. If there's an error, that leaves open the possibility that there's more errors, right? It shows that it's possible to have errors. And also, the size of the errors matter. So, you know, an error of $500 is different than an error of $50,000. So the size of the error matters as far as trying to figure out this, you know, one side, the half bell curve. So these projected misstatements are important because they are that additional amount of possibility that things could go wrong. Now, as long as the book values are less than the intervals, they will go into the incremental allowance. Now, this one's worth 10,000. The book value is 10,000, interval is 50,000, so it'll be in there. More could go wrong in that interval. And the book value of this one is 4,000. Again, more things could be wrong in that interval. This one, nothing was wrong. Even though it was misstated the wrong way, and so we ignore it. So there actually wasn't a misstatement here. Okay, so as long as the book value is greater than the interval, let me put that up here. Scratch that, I said that backwards. Less than the interval. It will be included in the incremental allowance. So this first one, in there, yes, it's going to be part of the incremental allowance. The second one, is it in there? Yes. Incremental allowance. This one doesn't matter. It wasn't misstated at all. There's no decision to make on that one. Even quite honestly, even if you did, it's 0. It wouldn't make any difference because we multiply these by an incremental amount. So, you know, 0 times anything is going to be. Oh yeah. Okay, so these two mean that this could be.
I have a question.
Yeah.
I know. So you can. So do we choose no? Because I know it's understated, so it's ignored. So in this case, you choose no, right?
Well, actually, this one isn't misstated at all. Yeah.
Yes.
I know that sounds odd because you look at it and say, hey, there's a misstatement here. But actually, because the misstatement is an understatement, it's completely ignored.
So we don't choose yes or no?
You don't need to. Even if you chose yes, 0 times anything's gonna be it. But yeah, you don't need
Okay.
it. I guess here no would be fine because it's not.
Oh, okay.
But if you remember back to this thing up here,
Yeah.
then notice that we had. Yeah, I did put no for that one. You're right.
Yeah, we just know here.
So up here though, you notice that these are ones where it was bigger than the interval. These were also no. You say, well, why were they no? Well, because that interval can't be any worse. It covers the entire interval. So there can't be anything more wrong with that interval than already is there. So that's why those are no. These down here, because they're bigger than it. But yeah, no would be probably the most, to answer your question more directly. Yeah, no would be the most direct. Okay, so incremental loss. Now this is gonna be wacky, and this is one of those things that I wish, well, a few times I wish I wrote auditing books, but here goes. So here's the wacky part. We go to the reliability factor table and we look for the overstatements for 1 overstatement versus 0 overstatements. And probably the easiest way just for me to get right in here and do this. Okay, so here's where we're at. We're going to use these. Okay, so at 1 overstatement, it's 475.
Yeah.
At 0, it's 3. So let's jump back to our problem here.
Oh, okay.
Okay, so this is from the table on this previous page here, so. And then here is another wacky part of it. And that is, then we subtract 1. That's going to equal. So 475 minus 3 is what, 175. So this would be 0.75, I think.
Yeah, 0.75.
So this is our first increment. We're going to do the second thing here. Go back to the table. Now this is overstatement 2 versus overstatement 1.
Oh,
So overstatement 2 is 630. Overstatement for 1 misstatement is 475. So 630, 470. Okay, so back to here. That equals what?
0.55.
Yeah. Thank you. So this is 0.55. Yeah, let's go ahead and do the third one just for laughs, I guess. So this would be 7.76 and 6.30, so 776. Point 0.46.
Yeah.
So these are the increments. Okay. Showing increments. Okay. So well, let's go back to our problem here. Okay, so kind of reiterating what we just did. The first one was 4.75 minus 1 equals 0.75. This is kind of what we just did. And I'll show you what we're going to do with these in a second. I'm just going to put these in just for. So the next one would be 6 point, oops. All right, last one was 7.6. One. Now, what we're going to do with these factors, these the increments here. So these are the increments, the 0.75. The times the misstatement, and we're going to start with the largest one first. So you can, okay, there's misstatements up here. Which one do you take? You're going to take the largest one first. So this is the largest. Put here. So you can start with the largest and then go down the line. Now we only have 2 of them here. So the largest starts at 30, the next one will be 10. So the first increment is going to be equals some number. So 0.75. So the amount that this could be off by is 22,500.
Yeah. That's right.
And we're gonna do the same thing for this one, but now with the 10,000. So this would be and we're not gonna do anything with the last increment.
One is it on 0?
Yeah, it's not, there really isn't, well, you know, even if we did multiply, it'd be 46 times 0, it wouldn't make any difference. So this is and there really isn't one down here. You don't need to do this, but if you did, you know, if there was a third
Yeah.
one that we include in the incremental, you do it, and you do it down the line. Now, you can kind of see a pattern here. You could easily make an incremental table, right? I mean, you know, we go back to this thing and do these calculations, but they could just easily make a second table that had the incremental on it. You know, instead of jumping through these hoops. But And there you have it. So, yeah, so this is, you know, the incremental allowance. So we're saying, okay, look, because this is a sample and we have found errors, and these things could have more errors because of the errors we have, and also because of the size of the errors. A bigger error means there might be bigger problems than smaller errors. So it takes into account the size of the errors. So the 22,500 versus and this one 5,500, these are extra amounts that it could be off by. So those two together will be this. 20, I think it's 28,000. You want to check that?
Adding the two, oh.
So
yes.
22,500 plus
77.
is 20,000.
27. Yeah, 28,000.
So this incremental allowance would be another 28,000 that could be off by. And again, it's off by, it could be off by that because of the size of the errors. If the errors were small, it would be a smaller amount. Or vice versa. If the errors were larger, it'd be a larger amount. So the incremental allowance, it's a wacky one.
Oh, okay.
But it has to do with the errors, if there are errors, and the size of the errors are also important. A little error, little problem. Big error, big problem. That was the hot car that fell over, in case you wanted. Okay, so this is what we'd use, and our upper limit would be all these together. So just to go back to this thing. So we're saying, okay, this thing could be off by another 28,000 because of incremental errors. So our best estimate is off by 40,000. But now the upper limit of what it could be, this is the upper limit. You know, the upper limit of what it could be is it could be up by another 28,000 because of incremental loss, and another 150,000 because of basic precision, and that's if we didn't have any errors in it, any misstatements. So it could be off by an additional all those. So the total amount that it could be off by is a 40. Ooh, that kind of, it's not so bad. It's funny, on the paper it looks like it's completely gone. You know, so it could be up by 40,000 because of our projected misstatements. But it's a sample, so it could be up by another 28,000 because of the incremental allowance and because of the basic precision, which is just, if nothing was wrong, it's a sample, it could still be. Okay. No, I don't want to log on the screen. All right, so coming down here, the upper limit would be these three. I was going to copy them and clean them up down here. Yeah. Okay, so all these together will be that. Apologize for my formatting on this, it's not the best. So the upper limit on this statement would be all the three of those together. 218?
When you add everything?
Yeah,
Oh,
is that right? I think it's right. 190.
I'm checking it right now. Yeah, it's 280.
So this is what we're saying, the upper limit. Our best estimate is that it's off by 40,000, but it could be off by as much as 218,000.
Oh,
And this incremental allowance is, oops. This incremental allowance is that misstatement size matters. Yeah, so that, you know, if these are little misstatements, it won't matter very much. If they're big misstatements, they matter more. So the size of the misstatements matters. And so this would be the upper, and this would be kind of the, you know, the number that you'd be looking for when you do the sample. You say, okay, according to our sample, it could be off by, our best estimate is off by 40,000, but because it's a sample, it could be off by as much as 218. So this is at and that might fit. That might fit. Okay. Question on that thing?
no.
And again, this has appeared on the CPA exam several times. Very similar type problem to this. Okay, here's your job for next week. This will be homework number 6. I know you only been through one of these, but as you can tell, they take a while. So there's only one more left. Yeah, we'll talk about the rest of it later. Okay, so this will be your job for next week.
Okay.
Oops, not next week, next week. And don't be afraid of making a mistake.
What's the deadline to turn it in?
It will be a week from next week, so it'll be on the, what is it? The deadline will be probably the 15th.
15th, okay.
You'll have time to do it. So next week though, complete, and we'll go over it, but try it on your own.
Okay.
Yeah, you know, it makes a difference to. So complete this one. Now be careful a little bit. I'll say a couple things here. It's not 5%, it's 10%.
Okay.
Oh. Let's look at these real quick. This will help with your going through. What do we do with this first? I tell you what, let's go. This is if people make mistakes, they usually make it here. This is usually when they make it. Believe it or not, the basic precision, basic precision is pretty easy. But even the incremental allowance, people usually do okay with those. But here's where you're gonna make the mistakes. This first one, what do we do with it?
It's higher than the book value, so isn't it 0 automatically?
Yes, that's exactly.
Yeah.
The this is an understatement. It's not supposed to be.
Okay.
We can't, so this would be 0,
Yeah.
right? I mean, it is misstated. So it is kind of hard for us as auditors. You say, well, wait a minute, this is wrong. But at the same time, it's we don't need it. Okay, number 15 looks fairly straightforward. Nothing crazy there. This is an overstatement. It's not bigger than the interval. The third one here, this is the one that's going to trip up people. If you get tripped up, this is where it's probably going to be. What do we do with this third one? And this goes back to problem number 4. You'll notice that the
Yeah, the
book value is greater than the interval. So
Oh, that's right.
you're going to subtract. So 108 minus the 95. That's what the misstatement is.
Yeah.
Whatever that is. 13?
Uh,
I think it's 108,000 minus 95,000. I think it's 13,000. So
Yeah.
you don't actually go through the calculations. Now this one down here, sometimes they'll say, look and see why this is 0, which is kind of a stupid thing to say. You would look and see why it was 0 anyways. But yeah, I was assuming that it is a normal one. Everything would be okay on this one too, similar to number 2, in that they say it's 12,000. It really should be 0, and then project over the interval. So this one down here, whatever the misstatement is, I think it's 13,000. Oops. And this one would it be in the incremental allowance or no?
No.
no.
Nope. Would not be in the incremental allowance because it couldn't get any worse. It covers the entire interval. It had a 100% chance of being picked, by the way.
So the projected value will be the difference between 113,000?
No, it'd be so this 13,000. This will be. Oh, here I'll put the calculation here. So
100 minus 100,000.
yeah, this would be
100,000 minus the 30,000.
so 108,000. It's what the thing is actually the actual misstatement.
Right.
And this is the actual misstatement. Cap lock. Yeah, so this one, so you use the actual misstatement because it's bigger than the interval. And we know what this one is misstated by. It's misstated by 13,000. Which if you actually go through the way that we did it before, it would reduce this amount. It'd be sort of like the opposite of sampling. It would take a larger amount and squeeze it down into a smaller amount, which doesn't, So if the book value is greater than the interval, there's actually 2 things that you know. First of all, it's 100% sure that one would be caught. So if they ever cook the books above 100,000, it's going to get caught. And secondly, you know that you're going to use the actual misstatement. Nothing else could go wrong in that interval. It covers the entire interval. So it's not going to be. Okay, so going through here, now I'll let you guys do the calculations on. Mark this as no. This one's not a misstatement, so we won't do it. These two are going to be yeses because they're normal, well-behaved sample items. They're less than the interval, and they are overstatements. And because they're overstatements, we like them for this method. If they're understatements, we don't care. We ignore them. Cast them off, look at old equations. All right. So anyway, so this kind of will help you get a start on this one. So this is, this one is not misstated. Okay. So for next week, let's do this one. I know you probably had enough of sampling, but there actually is one more handout to go through. But this one next week. So this will be the we'll go through this one, and that should wrap up the monetary unit sampling. Question on that? Okay, and hopefully next week we can finish up the chapter 10 handout. So next week should be a finishing up week. Any questions? You guys had enough auditing? I think I have. Raise your hand. Okay, yeah, that's unanimous. All right, so we will tune in next week and go over this second half of class. First half of class, we'll probably do the chapter 10 handout again and finish that one up. And we'll probably have the next week. We may have the chapter 10 and 11 exam, practice exam. I mean, I'll take a look at it and see. I'll know more next week. I'll know 1 week more next week. So, okay, any questions on this?
No.
All right, give it a shot. Again, don't be afraid to make a mistake. We'll go over it in class. So. Okay, good night, and I will see you in a week.
Okay.
Thank you.
Okay, thanks, guys. Save this. Save that.
Professor, I have a question.
Yes.
Like this week, there was no any assignment? Like this, like.
Oh, for
last
today's
week?
class? No, there wasn't.
Okay.
I just waited.
And the assignment we submitted, I just wanted to check that we were supposed to make notes for the handouts from chapter 1 and 2.
Yeah, whatever you have there, I'll take. The handouts after that one will be a little more concrete. You'll notice that for the chapter 10 one, we're actually doing bank reconciliations and other things. So yeah, there's not much in that. It's all just definition stuff.
Okay.
Yeah.
Okay, thank you.
Try to ignore that. I'm not ignore it. I'm trying to avoid it for a couple of reasons. First of all, I don't think people remember it. Second of all, take the CPA. If and when you take the CPA exam, you'll learn it again there. So in that one, you'll remember it. So okay.
Mhm.
Any other questions?
No, I'm good. Thank you so much.
All right. Thank you. All right, bye.